Larry and I were talking before the break, and it's kind of a weird environment that we're in with stock prices and given interest rates. I mean, interest rates are what, at all-time lows? What's the 10-year Treasury? A point and a half? And we got pretty high valuations when it comes to stocks.
Yeah, we have one all-time lows for the 10-year Treasury. Currently, it's about 136, so setting records. And even the 30-year, believe it or not, is down to 2.1%. And so, and along with that, we have very high historical stock valuations, at least in the U.S. What's called the Shiller cyclically adjusted price earnings ratio, or the Cape 10, is at a level of 26, which is way above the historical average of 17, and that's the best predictor we have of future expected returns. So I'll just do a little quick math for your listeners, Joe. Historically, stocks, both international and U.S., got 10. Bonds about 5.5, so a typical 60-40 portfolio would have gotten you somewhere in the neighborhood of 8%. Well, today, with the Shiller Cape 10 at 26, that projects to roughly a 4% expected real return to U.S. stocks, because you take the inverse of the PE, gives you an earnings yield. So let's just round it and call it 4%. Add 2% maybe for inflation, you're at 6. And if you have an average bond portfolio of 5 years, today the 5-year Treasury is 1%. So if you're a U.S. investor and getting 60% of your portfolio going to return 6% and 40% going to return 1%, boy, you're talking about a 4% return, which is half the nominal, return that the typical 60-40 portfolio has earned over the last 90 years. So that's a real problem for many investors who make the mistake of relying on historical returns. They're likely to end up alive with no money.